Hello, everybody. Chris Hahn with Jam Mortgage in Alhambra.
And then Lena.
Hi, good morning, everyone. Lena Sencari from Osvaldo Home Mortgage.
Good morning, I'm Helen Chen with Refine Lending.
Okay, so we're going to start our lender panel with a question for Chris Hahn. Chris, what are the biggest challenges and obstacles today in the lending world?
Okay. Thanks for that question, Joe. I'd first like to kind of take a little survey of the audience and see what you guys think are the challenges and obstacles that you've been running across on transactions. Anyone have any challenges that they've seen before I go over what I think the challenges are?
Appraisals?
Yep, okay, that's a good one. Anybody else?
Interest rate.
Okay, of course, that always is a challenge. Anybody else?
Condo approvals
Yeah, that's another one too. Okay.
and also loan to value.
Mm-hmm. Yeah. Okay, so I'll go over some of those things because there are some changes in those areas. And there's going to be more changes, unfortunately. As Dodd-Frank continues to roll out, lending will continue to tighten. It's been a tough couple of years, and unfortunately, I think another 5, 6, 7 years from now, it's going to get even tougher when those rules fully come into play and the debt ratio is lower to 43%. But some of the things I wanted to talk about and cover that I see as obstacles on transactions or challenges are one, debt ratios. Debt ratios have been lowered dramatically since prior to 2008. There were transactions that were Fannie Mae deals you used to be able to do to 50, 55, 60% total debt ratio, which probably was a little too aggressive. But at the same time, those were full qualified loans, people who had money to put down and everything else. What I'm seeing now is that with the lower debt ratios, the problems that come up are people who maybe have co-signed for a family member on a car loan. That makes it really tough. So anytime you have clients that you can advise not to co-borrow with family, if at all possible, do that. Because I often see sometimes it's not even a co-signed loan, it's a loan that they took out straight for their son or their daughter. If it's a co-signed loan and we can get documentation and proof that someone else is making that payment, then we don't have to count it. But if it's not co-signed, if it's only in the parent's name and they're the ones buying, you're going to hit them with that payment even if the other party's paying it. So that's one challenge that I see. A big challenge I see is undocumented money coming into transaction. As a lender, it just makes our heads spin and it's real difficult to work around. Lenders, for whatever reason, don't like cash. You'd think you'd be allowed to have cash at home and to use it for a transaction, but ever since 9/11 and having to document where money comes from and anti-money laundering laws and everything else, cash money coming into a deal will mess up your transaction. So you really want to, or us as lenders, prepare the borrowers well in advance. If there's money that's going to be moving around, move it around well before you get into escrow. Most lenders are going to look at the last 60 days of bank statements and transactions that occur. And if they see large cash deposits, you're going to have to document it, or in some cases you can't use it for the transaction. So that's a big obstacle. Another thing I see coming down the line that's going to be more and more of an obstacle is student loan payments. I'm seeing more and more kids coming out of college with large student loans, and those payments really affect their qualifying. And that's actually going to change and get a little worse, and I'll cover that in another area, another question, but those are probably some of the main things. There's something coming up almost immediately, starting as early as next week, called collateralized underwriting. It's going to be another layer of automated underwriting that works with Fannie Mae's and Freddie Mac's automated systems. But what it's going to do is scrutinize appraisals a little bit more. It's going to make it a lot tougher for variances in value. I don't know how it's going to play out yet, but it scares me a bit. I know that we have enough pressure with underwriters looking at the appraisals very tightly and having us address issues on them. But to have another layer of automated risk calculation coming from just systems that look at parameters. The appraisal is going to get entered into this system, and it's going to get a score, and that score can affect the borrowing. So we'll see how that rolls out, but I think that's going to be a challenge coming up in the near future too. So those are just some of the things that are coming down the line, and unfortunately there'll be more, but hopefully we'll get some good changes too.
All right, thank you, Chris. Lena, what are some of the items needed for the loan pre-approval process?
Okay. Loan pre-approval process is, a lot of people think it might be a lot of documentation needed, but in reality it's not that many. Just remember it's 2222. So that's what I'm always remembering. So the first two will be to most recent tax return. So now we still can use 2012 and 2013. Pay attention to, we need all pages, especially you have to pay attention to Schedule A and Schedule E. So on the Schedule A, the very important thing that you have to look at is non-reimbursement expenses. So if your buyers tell you, okay, I make $100,000, but what if he filed non-reimbursement expenses for $50,000? How much can we use? $50,000, right? So even though how much they make, if they reimburse so much, we cannot use the income. We have to deduct it out. So that's how lender sees. And also another thing, pay close attention to Schedule E. Schedule E is the breakdown of how many rental properties income that the buyer filed on the tax return on that year. Even though they said, okay, I have 10 rental properties. If you don't file on the Schedule E, there's no purpose of having them because we cannot use those rental income into qualifying. And rental income also, it could be on a positive side and the negative side. If on the positive side, a lot of times that underwriter can add back some of the deductions and use that as part of income. But the same thing, what if they file rental income as a loss? Too bad, we still have to use that to deduct out from their income. So pay attention to that. And the second two will be 2012 and 2013 W-2s. That's for wage earner. For self-employed, we'll need 1099. Or whatever they have, any additional income, retirement income, pension income, social security income, those incomes will need that to be verified for 2 years. The third two will be two most recent pay stubs. So if they get paid bi-weekly, we'll need to cover 1 month. If they get paid monthly, we'll need just one. The last two will be two bank statements, and this can be tricky, like what Chris said. We need all pages, and I want you to really, coach your buyers. Like, we have a lot of buyers who have cash at home tucked underneath the pillow, right? That's right. And they say, oh, they have this much so and so, but they don't put in the bank. And to lender, we can use that if they deposit that prior to opening the escrow. It's too bad. We can't use that cash at all as part of the down payment. And also with large deposits, even though they think, oh, it's wired from here and there, it also has to be sourced. All large deposits have to be sourced. It used to be very easy, but nowadays, if they can't provide any documentation where the money comes from, we cannot use that as part of the down payment. Thank you.
Thank you, Lena. And now for Helen, what is an FHA loan?
Okay. It's a home loan that you have a down payment less than 20%. Hello? Hello? It works. Okay. It's a home loan that you have a down payment less than 20%. And the minimum down payment required for FHA loan is 3.5% down. And this is a government mortgage that is insured by Federal Housing Administration. And this loan is started insured by the FHA since 1934. FHA loan have very helpful for a person who has low income, and also it's a high risk. Therefore, we have mortgage insurance on that. the FHA loan ratio is more flexible. It can go up for 45 to 55. Some lender does that. It qualify, also some lender, if you have runs automatic, DU approved, they'll qualify. So it depends lenders. And it's a great loan for the first time home buyer who has low down payment. It does the mortgage insurance, and there's a two type. One is annual, monthly premium, and the other one is one time. So there's two insurance. The annual premium is required at the closing time. You can finance it. That's a FHA loan.
Okay, thank you, Helen, thank you. Okay, Chris, are there any new or upcoming changes in FHA financing?
Thank you. Yeah, actually there is. There's been a few changes in the last few years, and then one that's actually coming up on Monday for the better, which is great, a good change for once. In 2013, we had a big change in FHA loans in regard to the mortgage insurance. It was, I think, April 1st of 2013, they reinstituted lifelong mortgage insurance. So if you have a transaction where you're putting the minimum down payment, the mortgage insurance, whether it's a 15 or 30-year loan, it's going to stay on for the life of the loan. You have to put 10% down or more to have it be a shorter term. It'll drop off in 11 years. So in most cases, you're going to build equity faster than that. You can probably refinance out of it once you have 20% equity and get rid of that problem. But one of the big changes that just occurred on the 31st of December, and it was very helpful since the whole mortgage crisis happened, is they had a temporary flipping waiver for properties that were recently purchased and flipped in less than 90 days. FHA was allowing that for a period of time. There were restrictions involved in regard, and different investors had different takes on it. Some would allow 20% appreciation, some 100%. Some you might have to get 2 appraisals. But nonetheless, that has gone away. So if you have properties that investors are flipping, know that an FHA offer cannot be accepted on one until the 91st day. Nothing during the first 90 days. Fannie Mae and Freddie Mac have some rules on that too, but truly it's more the investor overlays that are causing problems than Fannie or Freddie. Fannie and Freddie just say, hey, if you bought a property and you're selling it for more, we want to see some work was put into it and its actual value that might have to be substantiated maybe by other second appraisal or other things, but Fannie and Freddie don't really have a rule on it. But it's all the investors put their own overlay on top of those rules, so it makes it a little bit tougher. So that's gone, so gotta wait 91 days now. The big change that's coming up on Monday, which is a really refreshing change, is that back when they changed in 2013 and made lifelong mortgage insurance, they also increased the premium on the annual or monthly mortgage insurance to 1.35% of the loan amount. On a $400,000 loan, that's like a $430 MI payment. Monday, it's going down to 0.85%, a full 0.5% reduction. That's going to save about $160 a month on a $400,000 deal. That might give a buyer $30,000 more in buying power. Nonetheless, it's a welcome change. It's actually going to make it even more competitive than conventional. Conventional 3% down is going to be FICO score driven, so you're going to have a different PMI amount at a 620 to 679 score than you'd have for someone who has 740. And it could be as high as like 1.48% for a 3% down conventional with a lower credit score versus FHA having 0.85%. So that's going to be a really welcome change. And it's coming up on Monday. So people have transactions right now. We're having to do a little juggling there because we're having to cancel old case numbers, order new ones. The government is allowing a process to be done so that people can take advantage of it. But it's a great thing. It is going to make FHA even more competitive. FHA, like Helen was saying, is a very easy loan compared to conventional. It's not so credit score driven. You don't need to be 720, 740. If you're 620 to 640, you can do it. And like she said, some investors can do debt ratios to 45, 50, 55%. So that gives you a heck of a lot more buying power, sometimes as much as $100,000 or more. So keep it in mind for your clients. I know in this area, people are less familiar with FHA and sometimes afraid to do it. It's so similar to conventional right now that there shouldn't be really a fear to do FHA loans, so.
Okay, great, that's some good news, some changes that are very helpful this year. Helen, what are the do's and don'ts when you're getting a new home loan?
Okay, well, don't apply for a new credit card. Because, this can lower your credit score and increase your debt. And then don't close any credit account, because a lot of people do the zero interest balance transfer. And this is a bad one for your credit score too, because it will lower your points. And the third, don't move your money around without a paper trail. A lot of people will say, oh, I just lent some money to a friend of mine and gave me a cash back. I don't have a paper to document. So don't move the cash around, and unless you have a paper trail, okay? Don't increase your debt, this is for sure.
Okay.
Yeah, and don't skip payment or make late payment. A lot of people think, oh, maybe I'm doing a refinance, I don't need to pay my mortgage payment this month, and it's not. And I just done a loan last month. Actually, I pre-approved them a few months ago. They have a higher FICO, and then by the end, in the process, they forgot the payment, and we had to do a new deal, and we find out it dropped 60 points, and it's from a 620 to a 550, something like that. And then to fix that, I had to tell them to pay back, and it's gonna take a while to prove everything, so it's gonna kind of, ruin your approval. And don't buy a car. A lot of people go out, oh my God, this is for sale, and this is beautiful car, I need it. But that is, if you buy with the cash, you lower your reserve. If you buy with a loan, you increase your debt ratio, and this may not, you might not close your loan. And then don't change job. The last minute you would call funding and they said, oh, he's no longer working here. And then I said, what's going on? Oh, I just changed my job. But then we have to do the 1003, the job, and verify and get the approval of a new pay stub or contract. So that also is, try not to change your job, before you close, and unless you have to. And don't spend your savings, that's for sure, because you don't want lower to your reserve. And what you need to do is save more money, and also when you read when you're signing all your application document, read careful on the fine print and pay everything on time. Don't because you already run the credit report, now it's okay. Because sometimes we have to rerun your DU and everything comes up and you didn't know. And borrow all this money is not free. You had to pay, so you had to start trying to save and pay your payment on time. All this do and don't action that can, make your transaction smoother. And especially like they're talking about the cash, you should tell your client before they come in to apply, if they have a lot of cash, make sure they deposit all their down payment in one account and make sure they season at least 2 months. Yeah, that's a requirement.
Okay, great. So yeah, the last minute changes and irregularities in finances and
Yes.
credit. Okay, watch out for that. Okay.
Yes.
Chris, are there any zero down loan programs for new home buyers today?
Yeah, there actually are quite a few different options that allow for zero down. And first, let me preface this by saying I know a lot of people have different feelings about zero down and how the zero down was a cause for a lot of the trouble that we had over the last few years. But I have to beg to differ on that a little bit. I think that At the time those zero down transactions were being done, yeah, that was an ugly animal. If you got zero down, you could have bad credit, not have to state what your job is or your income. That's a recipe for disaster. But with the zero down that's being done today, it's all for first-time buyers for the most part. The way that they do it normally is you'll have either conventional or an FHA first mortgage that's then subsidized by a government-assisted or some kind of government-sponsored secondary financing that's normally a silent second in most cases. What that means is there might be a second loan covering the down payment or 3% or maybe 4%, but it's silent second, meaning that you're accumulating interest in some cases it's zero interest, some cases there's no need to pay it back, but silent means there's no payment associated with it each month. So that's not going to add any additional risk to the buyer's monthly debt load because he doesn't have to make a payment for the life of that loan. It has to be paid off when they sell or refi, but it is a great way to help that buyer who has the job, has income, has credit, but they haven't been able to save enough money to make it happen. That's one of the biggest obstacles that I think when they do research, the down payment is what's keeping people from buying in many cases. So there are programs like Cal HFA, used to be called CHAFA, you heard in the past, California Housing Finance Agency, Southern California Housing Finance Agency. Many of the local neighborhood housing lenders have some assistance as well, but all of these can help your buyer to get in with zero down. I've had transactions where it was zero down, sellers paying closing costs, buyer still came in with a little money, but less than $1,000 in some cases. You can't even rent a house that cheap. You're going to have first and last month's rent and everything else, and a security deposit. The other type of loan that is out there that is zero down, and I think I would love to see more of it happening, is the VA loan. You know, we see our veterans coming back now, some of them gone through a ton of stuff, and I see it very difficult for sellers to accept VA offers. And I want you guys as representatives of our industry to think about that and know that, hey, they've done a ton for our country. We have to get back and look at those offers and maybe look at them a little bit stronger. They are zero down, but that's the way the government set it up. They don't have to put a down payment, and there's no mortgage insurance. There's a VA funding fee, but no mortgage insurance. So you just have principal interest, taxes, and homeowner's insurance. There are some costs that either the seller's going to have to pick up or the lender, or we do a premium price in the interest rate and try and cover some of that. But do keep those transactions in mind. We do owe a great debt to the servicemen of our country, and if we can look at some of those zero down transactions for our sellers and get financing for these people, I think it'd be just great. So those are the predominant zero downs that are available today.
Great, thanks, Chris. And the next question is for Lena. Lena, how can we close a 30-day loan in less than 30 days?
Okay, that's a good question. I'm sure all of you want to close it sooner than later, right? And nowadays, most of the agents will require either pre-approval or pre-qualification from the buyers before the offer will be submitted. But how many percent, what do you think is it gonna be? Your buyers are 100% qualified for the loan? I don't think so. Because pre-approval and pre-qualification letter is just a letter that's drafted by the loan officer. It has not been underwritten. So majority of the time, when we submit application, you will see there will be some hiccup. Either loan to value, debt to income ratio, or a lot of buyer qualification that could delay the loan approval. So instead of 30-day escrow that you expect that to close and you can collect commission check, probably it's going to delay to 45 days, 60 days. Worst case scenario, the transaction will be canceled. So here are what you need to know. So there's such a program that you can request your buyers to submit financial documentations to underwriter, even prior for them picking out the property. So what is needed is going to be the same requirement like we mentioned earlier, the 2222. So have them prepare, have them get it ready and submit. There's no cost to it. 30-day escrow, how many days do you think that it takes for the underwriter to issue loan approval? 1 week?
1 day.
1 day?
They should underwrite.
They underwrite, yeah, probably 1 day, but the process, right, before they get into underwriter hand, before they can take a look at that, probably will take up to, 5 to 10 business days. And that's half of the time that you're already in escrow. So why don't we just submit all this application, all the financial documentation, and get that started even prior to picking out the properties? So that will shorten your 30-day escrow into less than 30 days. And the loan process has started. And your buyers guarantee that the loan is going to get approved. Instead of you imagining, thinking, yeah, hopefully, cross the fingers, my buyer is going to get approved on the loan and there's no problem once the escrow is open. Right? Yeah. So, but just keep in mind, not all lenders provide this type of program. Just consult with your lenders if they have such a program like this. And this one is not EU approval. It's full approval from underwriter. Thank you.
Okay, that sounds great. Helen, we have one last question. What do I need to watch out for from buying a house that's being flipped?
Okay. If you buy a house that has been flipped, you need to check the city because a lot of houses, they have additional after they flip and they add a room or they add something. And you need to check if there's a permit, okay? Because I've been doing loans, some of the house they bought, they didn't know that wasn't permit. And if it's not permitted, if it's not a licensed contractor, we are not doing the loan because it's for, if the house burned down, you're not gonna get insurance covered. And then the only probably, if the room doesn't have electrical or plumbing, we're not giving you a value on that either, okay? And so this is very important, you wanna check who has been remodeled the house, is a licensed contractor, is a permit, okay? And there's also, it would be good that you hire home inspector, experienced one, to check all the remodel, what they do, what they've been covered under, and that will ensure your buyer. And also that I found one time is the, when they bought the house flip, and the last buyer just within a year or 6 months, and they still got a supplemental tax. And the title company and the escrow didn't find out until we're doing the closing. And so the buyer had to delay, bring out more money. So it would be good that the buyer or the escrow to find out and ask the seller if they ever paid the supplemental tax, because when you purchase a house, a lot of time that house could be like 10 or 20 years ago and much lower the taxes. And they didn't know if the buyer didn't have the additional fund, and that could get into trouble for closing. So I think that's important.
Be aware of property tax change. Okay.
Yeah, that's important. Unless they buy lower than the last buyer,
Right.
then it's no problem. So it's better you check, because I had the trouble of closing. Yeah, and then if you close and that wasn't settled on that, maybe then you have to, go back to title or find out who's gonna cover the supplemental tax, because you're not prorate, the seller hasn't, it's already closed. So,
Okay.
yeah.
Well,
I hope this helped.
yeah, okay.
Yeah.
All right, well, we're gonna open the floor to a couple other questions. If anyone has, okay, we have a couple questions.